auspicious.
All right, item number 6 on the agenda is the report from the investment branch process and portfolio overview. Chris, back to you.
Thank you. I hope this is much easier for you. The real intent of this, and we have done this actually periodically in February. I counted about 5 times. I've been here 11 years, where we knew we'd have new board members in February. We want to give you a good broad overview, but I would also remind the existing board members it's a great refresher. We actually do record this section, and they put it out on YouTube. And I'm heard it almost had a like last year, but it didn't even get a like. So I guess I'll have to figure out how to sign on and do that someday. But they do put it out there on YouTube. It was so bad we spotted it about a week ago and couldn't even remember why it was there, and then we realized we did it. So anyway, I am not going to go through all the attachments, but I would encourage you, take them out, staple them, or keep them online. They're a great reference. I've had board members in the past say that was really helpful. The history piece is something that's very unique to us. It actually was started 3 chief investment officers ago. I inherited it, and we just keep sort of adding pages. I think it goes through our history. You know, part of it is stuff, some of the lessons Ian will teach you about fiduciary. We have a black eye in our history. We made a mistake. We're honest about that. But it brings you kind of up to speed of how the portfolio changed, the laws around it changed. It really is a dramatic evolution from a small, what we consider small, kind of a $20 billion portfolio that was managed by the CalPERS staff in the 1970s and early 80s, to where STRS had one investment staff to where we are today as a global financial institution. I devoted a whole page to the 2008 meltdown. We'll probably slim that down over time, but it's so fresh in memory, and it is such a significant event. And then also to the most recent decade, I would highlight in the last page, INV 120. We want to sing, I guess, sing our praises to ourselves. I don't know, that's not allowed, but it's okay. CalSTRS did win from Institutional Investor the Money Manager of the Year Award for large pension plans. It was a great honor. No other California fund has won it, especially no other California fund in Sacramento. As you'll realize, there's just a tad bit of a rivalry in me there. Truth be told, they run our pension because we're not teachers, but it's friendly rivalry. And then just recently in December, really kudos go to Stephen and Carrie and the team, but AI CIO magazine, another real prominent magazine you'll see in the magazine rack at the airport. I'm teasing. But we won the 2011 Innovation Award. So that was very exciting. That was a lot of fun. But then also there's an overview in there that kind of goes through the portfolio. I'm going to hit on the high points of that. The investment policy, which I think is absolutely critical. That is the guiding document. We talked about changing it. But let me run through these slides, and these will be made available to you so that you can store it as a reference. You can refer back to them at any time into the future. And I'll use these again to brief the 3 new board members when they come on. But let's start. I'm going to start absolutely at the big picture, which is what gives you the authority to manage this, and how do we do it? And it really does start with the state constitution and the California Education Code. They're very similar in mirroring each other's language. But the key ones I put there on blue. Your responsibility on the investment side is to diversify the assets, minimize the risk of loss, and maximize the rate of return. So we often refer to that as kind of, get the most out of the portfolio with the minimum loss. Under the way the code reads, you are supposed to defer the cost to the employer, but obviously at our fund, that's the employer-employee, and you want to defray the cost of administering the system, so keep costs down. The one thing you'll hear from me all the time is in investments, it's tough to predict the future, like you experienced yesterday, but the cost is a definite hit to the return. And so we do focus on a lot here on the cost to run the system, both internal and external. So that's what gives you the overall authority. you saw this slide yesterday with the actuaries. They swiped it from me, but I'll admit I swiped it from Harvard. So, but it was the 1970s at Harvard that I swiped this chart. They had it in a book. I simplify it, but basically think of a retirement system. You know, we often get descriptions of what is CalSTRS. You know, if you think of General Motors, you can picture a auto plant. If you picture Boeing, you can picture a airplane manufacturing hangar. If you picture a pension fund, we always say think of a bucket. There are two flows in: contributions, investment return. One flow out, benefits. The water level is what you dealt with yesterday, the funding level. If you want to take it even further, the evaporation off the water is the expenses to running the plan. So what's interesting now is we do have a negative cash flow. We pay out about almost $6 billion a year more than we get in. So instead of being net cost buyers of assets, we're always a net cost seller. We're constantly thinking about where to raise more liquidity and what markets to sell. You spent a lot of time yesterday focusing in, you know, about how the contributions are affected. And the big one, obviously, is the investment return. We smoothed that return over 3 years, but it clearly has been highly volatile in the last decade. And it really does have a powerful impact at this fund, particularly on how full that bucket is. I am constantly amazed at how really good years help raise the water level a little, but bad years really drop the bucket quicker. The financial mechanics that's within the whole actuary stuff you talked about yesterday, the leverage that's in there, this plan is more sensitive to downside markets than some of the other plans I've managed in the past, and it's interesting. I haven't been able to put my finger on it. This is the funding status history. We talked a little bit about that yesterday. I show you this graph. In the investment policy, we actually have bands where we say that you're going to do an asset allocation study every 3 years. But if the funding level drops below 85 or goes below 110, you should stop whatever you're doing and look back at the asset allocation to see if you want to change that. The timing worked nicely. At the end of 2008, we were due for a study in 2009, and we did commence one. I also point out a lot of times when I do speeches to the teachers, like UTLA, that like 1984 and before, this plan for the 100 years that it's been almost around, we only have a handful of years, like 3 to 4, where it was above 100% funded. Historically, a teacher's plan in California has been grossly underfunded for most of its life. And for the teachers that worked in the 70s and 80s, this plan was very underfunded, below 60% funded. It really has only been, you know, since the 80s that we've finally gotten some footing and some grounds. And here's Alan Empkin, who was, no.
Sadly, I was around in the 70s and the 80s. But when you look at this chart, it's imperative to keep in mind that 100% funded assumed you made your actual interest rate assumption. Okay, you could not have gone to the market and bought a portfolio of bonds, which you could have done in the 80s, and defeased those liabilities. So that is an accurate assessment. That's the assessment that your actuary uses in your valuation. But you could not accomplish that objective today because the yield, as we discussed yesterday, that's available in the bond market would give you a return significantly less than that number would indicate. I just wanted to make that clear.
Thanks, Alan. You know, our goal obviously is to reverse that downline using a 3-year smooth. As I discussed earlier, we're rolling off. You're going to take the third bite of 2008. And what you'll find as an investment committee is there's kind of a different cycle between the investment committee and the retirement board because the actuary is going to come to you in May with that last bite of June 30, 2011. From our perspective, we're already off June 30, 2011, and we're worried about, you know, what did we do in 2012? So our results are going to be a little bit ahead of them, and you always, in May each year, you kind of have to go back in time, almost 12 months, and look at the world. So don't be surprised sometimes when we've already moved past that period, and then you guys are going back to revisit it at the retirement board side. This is our asset growth over time. The two things on there, don't worry about the absolute numbers, but you notice the slope of the rate of change. You have the rapid growth in the 1990s, and if I took it back to the 80s, it would be even faster. You have the decline of 01, 02 when we had the internet bubble burst, but then an awesome run of double-digit returns in the middle of this decade of the 2000s. But then obviously the tremendous loss in 2008 in the global financial meltdown. The red line I put on there is actually if you took the actuarial rate of return and compounded it from where we were in 1990, that's where we were overfunded and underfunded, sort of like where were we ahead of the game? When did we have a winning record? When did we have a losing record? And you can see that's a pretty steep slope, so it's going to be hard to climb up to that particular time period. Oh, that's that gives you an idea of the bull and bear markets. Sorry about that. This is a snapshot of our returns for the last 30 years. And I go back to that time period because prior to 1987, 85, the fund used book value accounting. So the return only looks like coupon income and realized gains and losses. It's not a full mark to market. So you'll find when we want to look at history, we're only going to go back to about 85 and forward. The green line is your actuarial assumption. What really jumps out is, as we call it, the lost decade, where we spent the majority of the negative years in 01, 02, and then obviously 07 and 08. But the rest of the years we have done fairly well. We have a couple of flat years. But it really is interesting when you look at over 30 years, only 7 of the past 30 years did we underperform the actuarial assumption. They all occurred, almost all but one occurred in most recent time period, which is why we're suffering through it. But that's also why we have so much debate about what is, as you experienced yesterday, what's the right rate. So I showed that slide earlier, but it's worth bearing in mind, and Dana and Harry and Geraldine know I'll show it again constantly. Sharon, you probably saw it in the back of the crowd all the time. It's a marathon. It's not a sprint. While we care about one-year returns and 6-month returns, we do care about really the 3-year smooth. But even it, I think that's a great saying, that even a 3-year smooth is kind of short for a fund that's 99 years old. So this is a bit of sort of the actuary chart for you. Those are our returns year by year. The green line is our 3-year average return. The red line is the old actuarial assumption. So basically, anytime the green line is above the red line, the unfunded liability is shrinking. Anytime it's below, it's growing. So the positive news is that after 2010, the line turned up. The good news is when we book 2011, the 21% return, the line is going to dramatically improve. It's still not going to cross the red line. It comes up to be positive. So that's where I said you have one more bite of that 2008 apple. The good news is after this May, 2008 disappears and is no longer in that 3-year smooth, and the line will, depending on how we do this year, should come back up above the average. This is in the book, but it bears repeating. Everybody talks about your investment philosophy. I think I remember Roger Cosberg, a board member, had a real problem with philosophy, but it is still our philosophy. We're long-term patient capital. We want to buy stable cash flows at a reasonable price. If that sounds like a great slogan, we'll be honest, we stole it from Warren Buffett. We added at a reasonable price. Because I think part of the key for us is constantly to challenge buying real estate, buying private equity. Are we buying it at the right price, given history? And that's obviously the key lesson we learned in 2007-8 was real estate had been running for almost 10 years, but we were buying it too high of a price. And then within the staff, we're very focused in on beating our benchmarks. It's something we talk about all the time within a risk-controlled environment. So, and I think I want to drive home, as we just had the talk about the policies. CalSTRS, compared to other people, is very policy-driven. Yes, you grant us a great deal of discretion. That's one of the differences at our fund, but it is very much within policies. And I think I've got a slide coming up that kind of helps you visualize that. This is that same slide again, which is the Civil War forward all the way to 2011. I think it helps all the time with the teachers because it really shows more in perspective. We do look at long-term history. We're not just looking at 2000 or the 1980s or 1990s. We do go back and look at longer periods of time. What's the philosophical or the academic foundation of the investment portfolio? It is rooted in core theory. You'll hear us talk every once in a while about Harry Markowitz. He lives right near a retired teacher in San Diego. I did try to hire him this year, and it's not going to work out so far. He's obviously not interested in responding to RFPs when you've won a Nobel Prize, but we're trying to figure out a way to do that. But we want to bring in, or at least meet with Harry Markowitz since he's here in the state. But he designed modern portfolio theory in the 50s. It was really widely more adopted in the 70s and 80s. And then he did win a Nobel Prize for his work in the 1990s. The asset allocation work is all based on Ibbotson-Singfield data from the University of Chicago, and then capital market theory and risk theory from Bill Sharp. And I would point out now we have a board member who was a student of Bill Sharp. So to my staff in the audience, Paul Rosenthal told me yesterday he took classes from Bill Sharp. So, What? Okay. But so we got to be on our toes.
It was Investments. That was the name of it.
Oh, well, and so Investments by Bill Sharp is pretty darn good. It all comes down to, from that theory, asset allocation is the key. As we learned in 2008, asset allocation can be bound together more than we think. But I'll focus in on this a lot with you. This is really the major decision. You only make this decision about once every 3 years, but I always tell you it is the most powerful investment decision you make. Statistics have gone back and looked over time. The difference between our portfolio and somebody else is mostly going to be driven by this asset allocation decision. Could be, some say 90%, some say down to 60%. There's a big active debate about that. But I can explain our return versus Canadian Public Pension Plan versus Audius or Government of Singapore or CalPERS first by asset allocation. We moved a couple of years ago. We used to have non-U.S. and U.S. equity as separate asset classes. Several years ago, we decided, no, the world is getting too correlated. That is one asset class, so we call it global equity. Some of our peers invest that, and you'll see in our chart how we divide up the world. Most of our peers, not most, some of our peers are going to a true global benchmark where the U.S. is only 50%, non-U.S. is 50%. We still have a home country bias, as it's called. So in our policies, global equity is 2/3 the U.S., only 1/3 non-U.S. So we're more tilted to the U.S. than our peers, and we think that's comfortable. As you heard me say, we've been in private equity since about 1989. We've been in real estate a little bit before that, about, I think, 1984. The first real estate this fund ever bought was our old building out on Folsom Boulevard that we used to meet in. Not a great investment. Sac State's having a hard time with it, but we don't own it. Obviously been a fixed income since our inception, since they started putting assets and then cash or liquidity. The small sliver there, as I mentioned earlier, of inflation sensitive is our growing asset class. When you look at this mix, what we discovered after 2008 is there is not a lot of inflation sensitive assets in the fund. The board definitely felt that with the level of government stimulus around the world, that I think the quote was, the economics playbook says 9 times out of 10 there's going to be inflation. And so we've been building that inflation sensitivity in. Frankly, I will tell you, we all thought inflation would be here by now. But clearly, based on Bernanke's statement, I don't think we're going to have inflation until beyond 2015. So we're not going to grow that asset class as fast or as feel the pressure to grow it as we did. We're still investing in that area, but it's not the immediacy. I would say all bets are off in 2015-16. We're going to have to find out as we get closer whether we think we're going to have inflation. Yeah, come on. You want a back one? Always.
Very, very clear. Although only half of the portfolio is in global equities, over 90% of the risk of the portfolio is in global equities. And it's just very, very important to remember what drives the volatility of your portfolio. And that is what changes the market value day to day is the biggest single factor is what happens in the equity market, because that dwarfs what happens in fixed income and the other asset classes in terms of risk.
Fixed income heard that upstairs, Alan, so now they're crushed. I'll have to go hold their hand. They're sitting behind. Hey, two other things I'll point out on this slide I didn't think about earlier. When you look at that, about a third of the assets are managed here in the building at CalSTRS, 2/3 outside. The board spent the fall looking at that, and in November recommended we increase the amount of internal management. I think at the staff we presented 3 different levels, criteria 1, 2, and 3. We recommended 1. The board surprised us and said, no, do 1 and 2, and then come back to us with 3 once you've done 1 and 2. So most of our global peers, and when we look at global peers, we're talking about just the Canadians, the Dutch, the Asian funds, Korean Pension Service, Government of Singapore, and some of the sovereign wealth funds. We find that about 60% of their portfolios are managed in-house. And so if you guys toured the trade desk with your orientation, you saw that we have open desk space, and that was part of the goal of this new building, was to be able to have the capacity to grow the internal. So you'll see more discussion coming, especially in April and June, about portfolios we're shifting and building internally, and so that will change over time. I am pressing the wrong button. That's pretty bad. This is the asset allocation over time, and I know it looks like a kind of a busy chart, but what I think is helpful is to really divide it up into different segments. If you really look at it before 1987, we were on the legal list standard. It was really in 85, 86 that the state passed a prudent person standard. So we were 80% fixed income and only 20% equity. Then, as you can see in 84, real estate, a little sliver starts. We shifted after the prudent person standard and separated from CalPERS, and we really went to about a 50-50 equity debt portfolio. So the light colors on that screen are where we're loaning money to people. The bold areas are where we're buying something, hoping it appreciates in value. What's interesting about that time period in the 80s up to 96 is the policy at the time was to be 70% in equity and only 30% in debt. There was a discretionary portfolio that was invested by the staff, and it tended to be more conservative. If you recall, during the 70s and 80s, the equity market really ran and was very strong. So we tended to underperform during that time period because equities were better than most of our peers. We started doing non-U.S. about 95, and that existed. But then you can see from 97 on, we shifted. It quickly climbed to more like a 70-30 equity debt portfolio. And then in about 2007, the board did an asset allocation in 2006 and revised it to where we're now, as we are now, about 80-20 equity debt. We've tried to be more stable in the asset allocation. You notice there's some big gyrations of bets in and out. So kind of to Paul's point of market timing, that was in our past. It didn't help. We're not trying to do it going forward. Part of the discussion has been about flexibility, but not do a lot of market timing, because historically the fund, if you look at our performance in the 90s, we were 4th quartile pretty consistently relative to our peer groups. I would say that from 97 on, during good years, we've actually ranked in the top quartile pretty heavily. The negative years of 01, 02, and the negative years of 08, the plan has done very poorly relative to peers in bad years. Part of it has to do with our sheer size. Part of it has to do with the tilts we have in our portfolio versus our peer group. But we'll get into that more later. This is a quick slide of the organization of the investment branch. And what I thought I would do, if you don't mind, take a little bit of privilege to have people stand up and actually introduce them. The deputy CIO is a position you guys asked us to create 2 years ago, and to try and reduce the administrative workload and the number of direct reports that I have. And as I mentioned, John Petzold, who was our inaugural deputy CIO, retired in December. John's going to come back at a future meeting just so he can say goodbye. John was a 35-year career state worker. He started with STRS when it was still not separated from CalPERS. So John was our institutional memory without question. But he retired. Michelle Cunningham, the director of fixed income, agreed to step up and serve as acting deputy CIO. So Michelle, if you'll stand up. And I want to open up to the new board members. Feel free to contact any of my staff anytime. They're totally at your service and open to call and answer questions. Then I'll run through each of the asset classes, filling in behind Michelle since she stepped up to be acting deputy CIO. We tend to view that as a pretty heavy job, so we divide it. We've used historically 2 people to be acting directors rather than just 1. And so we have co-acting directors in fixed income. Paul Shantic and Glenn Hosokawa are running fixed income for Michelle during this time period. That was fast. Global equity, as I mentioned, Trish Taniguchi, unfortunately, is not here because hopefully she's recovering well from her surgery. But you met David Murphy and David Castillo that work in that area. Real estate is run by Mike DeRay, who we got to wear a tie today. Just teasing him. And is Margot here? Margot Worth? Margot runs private equity for you. And then Deborah Smith. Where's Deborah? There she is. Deborah Smith is our director of operations. She runs our investment operations group. Am I missing anybody? Stephen Tong. It's not on there. Innovation and risk, as we said earlier. Stephen Tong. Sorry, Stephen. Oh, stand up. No, I know. You'll see a lot of Stephen because his items are pretty complex, and we spend what you'll find with us is we'll come in and spend a lot of time educating you and bringing you up to speed. I also want to introduce Solange Brooks, who probably stepped away, but she'll come up in closed session. Solange works with me in the investment executive unit. She also leads our diversity efforts and runs the proactive portfolio under Margot. So. And then Ann Sheehan, the key of corporate governance. She and Jack were named, one of the 100 most influential people in corporate governance this year, this decade. So we're very honored to have that. So this is the policy point I wanted to make, and I'll run through these quick. The key is we are very policy driven. So think about your outside boundary that you're given is the state code and the California Constitution, which I went through earlier. You hit it right on point earlier where you said the board should focus in on policies. That was something STRS had a governance consultant that came in 1997 and said the investment committee needs to focus on policies. So you can set policies as wide as the state constitution, but inside of it. Then within that, there's investment staff, and we have day-to-day guidelines and procedures. The intent there is that it can be flexible, that we can adjust those given the volatility of the market. We can go out to your boundaries at the policy, but we cannot exceed them. So our goal is to write policies or procedures that actually stay within your policy, give us the flexibility to expand out to it, but stay actually within it. So you'll find when we come to you like we did to ask for discretion in some area, we're writing procedures that are even narrower inside of that. We do manage 3 different trust funds. We spend almost all the time, frankly, talking about the defined benefit. The defined benefit supplement is invested the same way as the defined benefit, so that's easy. The cash balance plan is invested differently, and we probably ought to spend more time talking about it because historically it's been small and not growing, and we don't talk about it. And the other one is the Pension 2 assets. Those really have been governed by the Benefits and Services Committee, but at some point they need to come over to the Investment Committee. They're managed since the individual teacher gets to manage where their asset allocation is, and the assets are managed by TA-CREF. All of that, from the inception, like I said, it's been through Benefits and Services. But at some point, well, you'll have to figure out your governance, and do you want to bring that over on the investment side? Your policies. These are your clear objectives. what I would say is the first three we look at are set in state law. They're from the Constitution. They're in that rank order from the Constitution, and that's in your investment policy. We always tell everybody knows this is our objectives. Objectives 4 through 8 are set by you, and you have changed the rank on those at different times. We will revisit that coming up as part of the asset allocation study. Minimized cost used to be very high. Maintain public trust used to be at the bottom. And different boards have looked at that and said, you know, this is a higher priority to me. That's a higher priority. What I would emphasize is when you look at all 8 statements, of course you want to accomplish all of those all the time. But unfortunately, it is hard to be everything, and we have to do things in rank order. You've got to establish a priority of what do we want to accomplish, what comes before what comes first ahead of something else. Because you'll frequently be faced with the challenge of minimizing costs, but then if you want returns similar to other pension plans might be driving up the cost. And you've got to make those decisions. And now that you're a new board, you need to tell us in the future, is this the way you feel, or do we want to look at it differently? This is your policy structure to kind of give you a map. As I said, the investment policy we looked at earlier is overarching. It's the key. You do have, you'll hear the phrase ESG, which is environmental, social, and governance. It's a new phrase that's been catching on. You do have an ESG policy as part of your investment policy. You're one of the only plans in the United States that has one. Next, you do have a divestment policy that you adopted a couple of years ago. Then the corporate governance, a policy on California investments, and the currency policy. I put those up because they overarch the entire portfolio. They are truly umbrella policies that cover every asset class. Then you get into policies for all the individual asset classes. And so what you saw today was the global equity policy, the currency policy, which falls under or falls above the portfolio, and then the overall investment policy. But hang on to this. It'll help you periodically see as a map, where are we, what policies are we looking at. Compared to the other committees, the investment committee obviously spends a lot of time on policies. And the one thing I'm proud to say about us at STRS is our policies are succinct, to the point. If you go to other boards, frankly, and ask for their policies, you will get 4-inch binders, thick of them. And their procedure manuals become more policies. So I won't pick on anybody in particular, but funds I know. Here's our asset class structure real quick. We are about 70% passive indexed. So as David mentioned earlier, indexing is where you're tracking the index. So in S&P 500, we'd own all 500 stocks, ex the tobacco stocks. We go up with that index, we go down with that index. The team upstairs makes sure we own exactly the right stocks in the right proportion every day. Only 30% is active. We've debated that. We had a very lengthy discussion in the investment committee of active, passive 2 years ago, and then recently internal, external. So those are different things. In the non-U.S. area, we're predominantly in the developed markets, but we do have a slice of the portfolio in emerging markets. The developed markets are 50% passive, 50% active. We think they're less efficient, so there's more opportunity gain from active management there. The emerging markets, we decided to be 100% active because we were very worried about ESG risks in the emerging markets, and we wanted to hire managers who paid attention to them. If you're indexed, you own the whole market, good and bad. Fixed income is 80% enhanced and 20% active. That's also how it's managed. 20% is internal, or 80% is internal, 20% is external. Then the private equity, and then the real estate. The board spent a lot of time on real estate in the last year, dialing down the risk of the real estate portfolio, increasing the amount that would be in core and decreasing the amount that would be in value added, or probably in opportunistic. It is a huge portfolio. We own about 2,800 stocks across the United States. I often say to people, think of a public company, and CalSTRS is going to own 0.3% of that stock. If you added CalPERS. CalPERS typically owns 0.5%. So even together, the two of us aren't 1% of an outstanding stock. But take Apple. Everybody loves Apple. We in PERS are probably about 0.8% of the outstanding shares of that company. Even though that sounds infinitesimal, we're still going to show up as one of their larger shareholders because it's that diversified. They don't know that because it's held under our custodian name by all of our managers. We typically have to go to a company and tell them how much stock we own. It doesn't jump off their stock registry that CalSTRS owns that much of a percent. We've owned 2,800 stocks for as long as I've been here, and that's why we partially say to CEOs, we're going to own your company longer than you're probably going to be CEO. As long as they're public school teachers in California, we're going to own those stocks. We have about 2,000 stocks, non-U.S. stocks. They're in 44 different countries. We look at that on a regular basis to know, there are a lot of frontier countries that people are starting to invest in. Africa, parts of Asia and Latin America. We still don't do frontier countries, but that'll be up in our future to look at. The flags I put there are really the top five countries in rank order. The largest exposure is always to Japan and the UK. Then Canada comes next, and then Australia and Switzerland. The big difference is France and Germany used to be on there. They are now down there at number 6, 7, and 8 as they have had a crisis. They have fallen down. And notice, obviously, with Australia and Canada, the resource-rich nations are the ones that have risen over the last 5 years in stock market growth. We have about 350 real estate properties, and that's coming down because we're selling some, and then private equity. Now, this is a slide I added to this to kind of give you an idea of how do you monitor this portfolio. You set policies, you give us discretion, but how do you monitor how we're doing within those? And Ian Lanoff will harp on that a lot with you, which as he should as fiduciary counsel. So you do, as I've said, the asset allocation study about once every 3 years. You do that study over about 3 to 4 meetings. So it is not just a one-time meeting. It is a very lengthy process. We take a whole season to do that. You look at the performance, or annually, you approve the investment policy at least every year. We also really try to run the investment shop like a money management company. So we do business plans, and we present those to you in July. They're business plans by every unit. I ask the directors to think of their asset class as a company. What's the cost to generate it? What kind of profit are we going to get out of it? We present those to you in July. We also do a 10-year financial plan. We think forward of us as a company. How are we going to grow? Part of the reason we did that, remember the rapid growth of the fund in the 90s and 80s, they didn't anticipate that kind of growth, and so they weren't prepared. When they got there, they didn't have adequate staff. We didn't have adequate resources. So what you'll see in our financial plan is kind of a range of high and low outcomes for the fund, and we shoot for the middle, and we plan on it. You're not adopting a budget 3 to 4 years ahead because, as you know, you can't. You can only adopt a budget annually, but at least we have a game plan. I often say, you don't want to start out on a journey unless you have a roadmap. So to challenge everybody, you can't get to weed unless you got a map. I know how to get there. Semi-annually, so twice a year, you look at the performance of the fund in April and in September. Then also semi-annually, you look at all of the investment managers and how staff is rating them, who's doing well for us, who's doing poorly. As you saw by the size of the portfolio, you have over 250 external money managers that are involved in this fund. Quarterly, you get investment reports from us. Those are put on the web. I really want to emphasize those. We used to deliver them physically. The complaint was they're too thick. It's another 250 pages. Dana's nodding her head. So we put them on there electronically. Though what we have found out is you're not all reading them. So at the November offsite, we were challenged, come up with a new idea, and we did. We're going to do videotaped introductions that give you an idea of what's important. So if you go at the source that you go to look at those reports, At the beginning, we just did two. We did one for fixed income and one for real estate. You can watch a short video that highlights, here's what you should look for in my quarterly report. We'll get better at it. The communication staff upstairs is fantastic because they even show you click here, click there, do this. And what I think we'll also do, because the directors were so excited by the potential and the quality of the video, is we'll probably try and post some on the web for teachers of kind of here's advice, here's what we're thinking. We don't want to forecast what we're doing in the portfolio, but we're going to try and find different ways to communicate with you. And other than doing Twitter, we're going to try a video and see if that helps you. But we really want to draw your attention to those quarterlies. That the semi-annual performance tells you, like a report card, how have we done at the end of this period. But the quarterlies tell you what's motion, what's happening. So to pick Harry's example, the semi-annual is our record. We have a winning record, a losing record. That tells me something. But the quarterlies show you kind of how the statistics were of every game that we played to get that record. And it gives you a more in-depth idea of cutting it tighter. 8 times a year, I give you a Chief Investment Officer's report, sometimes long, sometimes short. And then, as you've seen, weekly, I try and send you economic updates, and I will send on-the-spot emails. The board can attest that during the summer and fall, when we had the U.S. debt downgrade, I will email you literally morning, noon, and night, because at night is when you're, at 5 o'clock our time is when Japan opens, and so we can know how the Asian markets have reacted. At about midnight our time, Europe starts opening up, and then obviously at 6 a.m. the U.S. opens up. And so at the height of the 08 crisis, at the height of this summer's crisis, I will try and keep you up to date, not only on major events and what's going on, but also what are we doing in our portfolio. So all totaled, I added those up. It's over 240 touch points that you get on the portfolio. Some may see that seems like a lot, but I think the challenge the board gave us at the offsite was more executive summaries, but also more detail. So we're going to try and find ways to give you better snapshots and executive summaries of what's going on. Kind of like Michael challenged us of annotating the notes. Here's what happened. Here's the key takeaway. If you want the detail, go here to get it. But we work hard to try and keep you visible and aware of what's going on. You've given us a lot of discretion. We honor that and respect that and want to earn that every year. So lastly, the page, I won't go through them in here, but just to give you a rough idea, it's a good handy sheet. We use this with visitors a lot. We had the China Investment Company come through this summer. We had a Swedish fund come through. We use this just to kind of give them a rough idea. So at the top, it gives you an idea of what that asset class owns, what's its benchmark, how do we measure it. In the middle is kind of that high-level structure. Then we get you into the substructure in the middle with some graphics, like this, what's U.S., what's non-U.S. Then at the bottom, we give you more of the detail of what's our manager structure. How much active, how much passive? Do we divide up active between large and small cap? And these are terms we'll explain in the future. The blue areas are where we're passive, following an index. The red areas are where we're active, hiring an outside manager. So that helps you with the key. Almost all of our policies have glossaries behind them. To the new board members, we want to give you a S&P dictionary book. The thing I would say is Wall Street is creating more and more terms. Our world is getting more complex, not less. The asset classes are getting more specialized. And we want to help you keep up with what we're doing. Your work plan, I just wanted to highlight that for you. I know many of you have already seen it, but here's your work plan for the year, and you set this. This isn't what we set. You set it. Your multi-year issues for us that we keep working on, definitely climate change, sustainability, and then the other is diversity of investment managers. Those are the two constant goals we've had now since about 2006. Each year, though, you adopt 2 or 3 specific goals to the investment committee. In this year, in the fall, we studied risk and our new risk overlay extensively and spent several meetings going through that. This spring, you wanted a review of the global equity portfolio at a very high level, and we're going to do that. And then in the fall, it had already been scheduled that we would do an asset allocation study, and that will take up most of the fall meetings. We'll come to you. You adopt your committee work plans in July. All the committees do. I'll come to you in May and start asking you, since the fall is already taken up in 2012, I will ask you, what things do you want to study or look at in 2013? The board gives us ideas. We let you vote on it. We create this, or not ranking, sorry, not just a vote. You create a ranking system, and that way you prioritize, here's what we want to study. And while everybody would pick a number one, usually the board's interest kind of rises to the top, and those become the goals that we study. So you're driving what the work plan is. I did it again, I pressed the wrong button. At the branch level, what I wanted to explain to you, there's some terms we'll throw around, and what in the world do they mean? The investment branch is pretty big. We have 110 people. And as I said, the units are really becoming specialized. And so I've been working very hard to try and break the silos down, get them to interact, get them to rub shoulders. We also wanted to create a succession plan where young people are given an opportunity to lead, not have to come and present in front of the board, but present in front of the staff. So these are some of the internal committees we have within the investment branch. I mentioned the Tactical Asset Allocation Committee. We also do have an ESG committee led by Philip LaRue, because that's where we're going to deal with ESG issues across the portfolio. We have a green team, and we're transitioning the leadership there to Brian Rice, but they're going to come forward and present to you. We have a DMI group, which is Diversity of Investment Management. Again, because that's overarching the portfolio, we're trying to pull somebody from every asset class to focus in on that and work together. There's a senior investment staff, my direct reports that get together. The investment accounting project has a complex securities group where we get together with Robin Matson's staff and try and help them understand the complex securities we're getting into and how do they account for them. We also have an equity return committee, which I'll explain at a future meeting. And then the diverse director database effort we're doing. And then Stephen has put together an innovation advisory committee to help him get advice on what should he study, what shouldn't he study, and be an extra sounding board before we come to you of how are things going. So we keep ourselves very busy. There it is. There's a complex security group. So lastly, you've taken a lot of time. I thank you for that. Talked you through lunch. But we focus absolutely on the teachers. If we don't do our job, they can't afford a retirement plan. We know that well. We love to have teacher groups come through because we don't get to interact with them like Peggy's group or the letter Jack read yesterday. Other than going out and doing speeches, we don't get the opportunity as much. So, we do drive it home. The staff absolutely knows that. The difference here versus other places is working for teachers, and most of them, I put them out there and tell them to open up to their families. At the height of the financial crisis, at the height of 2008, we were challenging the staff, go talk to your friends, be the word on the street. If you go to a Christmas party or a Hanukkah party or a holiday party, and be bold about that you work for STRS Investments and explain the plan and be there for people. So right on. It is a pleasure to get the honor to run the money for you because we recognize all the time, this is your money. You can hire any investment manager to do it. And the staff and I are honored that you give us the chance. And as we've said before, we want to prove that we deserve it and earn it. So without any questions.
Yes, thank you very much,
Great
Chris.
job, Chris.
Thanks, a lot of information. Appreciate all you do. Ms. Hendricks.
I first just wanted to thank Chris's staff, actually, Michelle Cunningham and Glenn Hosokawa. I hope I pronounced that correctly. My parents were here yesterday, Dean and Dolores Hendricks, and my brother, Dale, who is a high school teacher in Carlsbad. And so I just really appreciate Michelle and Glenn, you just taking my family around, and Chris. I think my brother felt like meeting Chris Ailman was like meeting Bono. It was like, I'm telling you, with less hair, of course, but no, my brother is like a total, he loves reading investment stuff, so it was a thrill for him, and so I know as a teacher, it was a pleasure for him to be here and just kind of we all know the environment at CalSTRS is really, we all love being around here because it's such a positive place and we feel so good and have so much pride in the staff here and what we do as teachers. So it was really a thrill to have my family, and thank you so much for taking good care of them. I just had a couple things, and I know it's late, so I can just throw these out here, and we can, but one thing I did want maybe for a future meeting, I would love to have a discussion, and maybe it's happened before and I missed it, but about the changes with the DB and the DBS, and I know kind of the asset allocation changed, and the DB and DBS are invested the same now, and just kind of a little more history around that, and then the CB, the cash balance, and why is that different? I kind of know in my head why I think it's different, but it might be a helpful conversation to have with kind of the new members. Let's see, what else? I wrote things down a long time ago. So the other question I had, Chris, and this is just, I did not take an investment class from Sharp, at Stanford. I'm a speech professor at a community college in Los Angeles, so I'm a liberal arts girl, and so I'm just, the investment stuff is really interesting to me, and I always appreciate the conversations we have in this committee because I'm learning so much, and I have a lot more to learn. I think one of the questions that I have, and I've been thinking about this given the market in the last few years, is just this balance between, I'm reading a lot about fixed income, and everyone's saying, fixed income is, is low and is going to stay low for a long time. And I wonder how how your staff thinks about looking at short-term. Obviously, we've had, a really strange 4 years, and I recognize that. But how do you balance kind of short-term investing and the long haul, like looking at 30 years, and with things like fixed income right now, and how we kind of shift our, I realize this is kind of a broad question, but that's just where I'm at right now in my development as a board member. How do we think about changing our asset allocation or changing how much we put into fixed income or something like that if we look at the forecast for the next few years and that balance between short term and long term?
Okay, but come on up. I'd be curious to get your perspective, Alan. No, it's a great question. I think a lot of that really falls on this board, though. The committee's personality and the committee's horizon. There have been times where the board has said, you know what, we're going to have a 20-year perspective, and we'd almost not look at performance annually. We'll only report it after the end of 20 years. Obviously, that's very hard to do. The financial crisis has caused horizons to come in much shorter. And I think from my perspective, I've been doing this 25 years with public funds. Our investment horizon is shorter now than it's ever been. It's a luxury to be able to think about the next 20 or 30 years, but we're very focused on the next 6 months all the time. And I think part of that, depends on the environment, but also the committee. The funding level of this plan it's acute and on our minds constantly. And so we have to very much think about that and the risk return and what we're doing. Your move yesterday, I sent that to the staff instantly, that we have 2 return targets. It's not fair to give employees 2 goals, but we have 2. You judge us 2 ways. One, on an absolute basis. We need to beat 7.5. Sometimes that's really easy, like last fiscal year we made 23. Sometimes it's impossible. But you also have a goal of relative performance. You want us to beat our policy benchmark by 60 basis points. So it's not fair, but we already know we're going to be judged on 2 completely different standards, but that's what we signed up for. But Alan, you've talked to a lot of clients. I would imagine that's a common view from trustees.
Well, I'm going to try to address it quickly and right to the point. I think it would be really good for you to get briefed from your fixed income staff on what they're doing in the portfolio to deal with the current circumstance. And I think that they would be more than capable of doing that, and you could schedule that for your next meeting. And that way you would get that. I think it would be good for the whole committee. What are they doing without displaying anything that shouldn't be public?
Sure. Thank you. And if the board has asked for some tactical analysis appropriate in closed session, and that is something that our Chief Investment Officer has begun to do as a direction of from the board in closed session. So we may get some of that insight at the appropriate setting.
And I would add, Sharon, you're going to get a heavy dose of that discussion, not just tactically from us, but then strategically, what do we do in that low environment for the next 3 or 4 years as part of the asset allocation? You saw in the assumptions from Alan yesterday, they're assuming a negative return, real return out of government bonds. It's hard to own any government bonds, but historically public plans have always owned government bonds as an anchor to safety, a windward anchor to safety. What do we do in that environment? So we'll spend a lot of time on that in the fall on that. Two last points I would like to make, I thought of it, if it's all right, Mr. Chairman. One is to just caution the new board members. I talked to a few of you last night, and you're probably not going to believe me, so I'm going to quote a former board member, but I say to the board all the time, you now have 150 billion reasons to be everyone's best friend. And I mean that, 150 billion. Geraldine's shaking her head, yes, she knows. New board members come in and they're like, yeah, right. So I'm going to quote, turns out it's a good friend of Paul's. Came on our board, he was a Stanford MBA, kind of knew his classmates, but didn't really interact with them much anymore. He said after 1 year on the board, he heard from every single member of his Stanford MBA class but one, and he attributed it to being on this board. So even though you may not publicize it, it's in the industry press, you're on TV right now, and I constantly challenge people to tell me, I don't know of any industry that pays its marketing people more than the investment management business. I think those people have the highest salaries and the highest incentive compensation to sell their products. And so you will be amazed at how popular you become. Joe Deere, when he became CIO at PERS, and he and I talk a lot, and I warned him of that everybody would hang on every word he said. Somebody would think he's a Bono. But Joe used the word intoxicating, which I thought was a very apropos but very powerful word, that he found it intoxicating. You will be younger, thinner, smarter. Your jokes are going to be better. Enjoy it. You're free to talk to money managers. Brian gave you guidance on what you can or can't talk about. This board has set very clear rules for itself, which we appreciate. The thing I always say is always feel free to give them my card and my phone number, because you'll pretty soon learn you don't want to be that popular. It's not that fun to have everybody hitting you up for stuff. And we're at a lot of conferences. Feel free to always say, you know what, there's the staff or there's the CIO, go talk to them. And we'll meet with people. We're very open on meeting with people. We'll take people off your dance card if you want.
Thank you, Chris. A couple other questions and comments from committee members. Mr. Reyes?
Chris, you just deflated my ego. I thought it was my looks. I thought it was my humor. I thought it was my anecdotal stuff, but okay, fine.
We think you're funny.
Looks aren't everything, though. A couple days ago, we talked about auditing and risk management. And it seems to me this is one area where risk management is critical at the staff level and other folks, because we've seen from our friends across the river, who shall remain nameless, they've gotten themselves into trouble. So, and there are a lot of sophisticated folks. Michael and I had a conversation about this yesterday as we talked about legislative proposals. So, people just keep looking different ways to sell their goods or package their goods and so forth. But is risk management in the investment committee managed by you, managed by whom? Or is this?
Yeah, that's an issue I think we need to look at over time. PERS is evolving how they do it as well. Right now, we divide investment risk and business risk. So business risk, right now they're both managed under Stephen Tong. What we would like to do is move business risk out and have that managed under the deputy CIO. So the classic kind of business risks of, where is our backup? Do we have a hot site? What are we doing with the staff? Are we signing ethics pledges? What's our insider trading? What's our trading disclosure rules? But then also the investment management risk is under Stephen Tong. And we're building out, we use a third-party system called Borrow One, and we're building out that staff as well. And it's worth taking a look at of whether that stays resident, all of that stays resident under the CIO, whether we farm out different parts of it. I think it would be very good for us to create our own compliance unit to make sure we're getting independent. The internal auditor practically lives in our shop, as you would expect. We're on a rotation where they're with us all the time. But should we have more of an independent compliance audit to policy and have that reported more directly to you guys? And I think those are things, it clearly is evolving within our industry. We have a risk staff that voted just to that, and risk is definitely defined out with that org chart in the investment policy. But we've learned, we've been meeting quite frequently with a lot of peers on risk. What are the Norwegian funds doing, the Canadian funds doing, and how can we push it forward?
We have Mr. Rosensteel and then Mr. Lawson.
Thank you, Chris, for a very interesting presentation, and it's nice to be working with you again after many, many years. One of the things that I haven't seen in the presentation, and I'm not quite sure how to understand it, is there is a trade-off between risk and return. If you want more return, you have to take more risk, which means that there's a greater potential downside. And Alan got up and said, 50% of the portfolio is equities, but it's 90% of the risk. Where in what we're being shown as a board are we getting an understanding of the risk that's involved, and are we in putting together our asset allocation model, are we making sure, are we monitoring whether the risk of that portfolio is what we thought it was? Because, portfolio theory means you diversify to minimize risk. Are we doing that? And what is the risk? So I'm just trying to understand how an evaluation of risk factors into the oversight by this board.
You've heard a lot from me, so I'm going to have Alan go first, but I think the rest of the board can say we've spent, gosh, has it been at least 9 months just working on risk? So, and it's not evident here, I realize that.
Okay. Two separate ways it's being done, none of which has been made obvious today. The first is you do strategic asset allocation. The strategic asset allocation uses Monte Carlo simulation, where you get to define what you define as risk. So risk could be the risk of a spike in benefit payments. It could be the risk of loss. It could be the risk of being in a peer group and being a poor performer. First, you define those risks. Then literally using Monte Carlo simulation on both the assets and the liabilities, they're modeled out by 50 years and a range of outcomes. And then literally you collectively go through a process where you define where you want to be on a risk spectrum. That's at the macro level. On a more technical level, we're working with your staff developing a true risk model to look at literally the exposure of the portfolio to various macroeconomic risks, inflation risk, growth risk, et cetera. A presentation was done on that at the last meeting, and that's an evolution. We're literally building a huge model. Then there's implementation risk, and we look at that at your quarterly performance reports and semi-annual performance reports. So there are a variety of ways that risk is looked at. There could always be more and better ways to do so. And what we've tried to do is come up with ways to help you look at risk. But you've raised, when the chart was up there and said, what are our goals? Maximize return, reduce costs. And at the end of the day, those are conflicts. They're not on the same thing. If you want to reduce risk, you're going to reduce return. I mean, that's the nature of the math. And the key is how to do that in the best way. But you point out basically what Mr. Sharp would tell you, is there's no love without heartache. And I had the pleasure of working with him too. And the choice is you need to balance the future financial issue of the plan and costs, to the extent you want to consider cost, with the volatility of the underlying investment portfolio.
And I'm just trying to understand not how we monitor that, how we oversee that, how the results. In other words, it's nice to know that what the return has been, But are we ever monitoring whether our understanding of the risk out there is accurate?